The trading, feeling overwhelmed, have no idea where to start, then this video is for you. Whether you've seen people trading on Instagram, heard your friends talking about Forex, or stumbled upon it yourself, this video is going to clear up everything for you. I'm going to walk you through everything step by step. What Forex actually is, the key terms you have to understand in this market, how to read a candlestick chart, how brokers and trading platforms work, how to manage your account and risk, and how you can start building your own strategy. And most importantly, how to avoid all the noise and BS that's in the Forex and trading space in general. There is no get-rich-quick nonsense over here, just straight education. So if you're ready, let's dive right in. But first, a quick intro about who I am and why you should listen to me. My name is Ryan C. I graduated with a master's degree in financial derivatives back in 2018. After graduation, I spent a few years working at hedge funds, financial institutions, investment banks, building up my resume and learning. And for the past 5 years, day trading has been my full-time job. Since my trading journey began, I've generated over $3.5 million in personal profits through Forex, crypto, stocks, and other investment classes. But more importantly, I've helped my thousands of students generate over $10 million in profits. So I think it's safe to say I've made and seen every mistake there is to make. I've blown accounts, I've recovered accounts, and everything in between. Honestly guys, this is the video I wish I had when I was first starting out. Something clear, concise, and honest. Throughout this series, there'll be a bunch of free PDFs available for download in the link in the description. Feel free to download them at any time and use them on your trading journey. So let's get started. What is Forex? Forex stands for foreign exchange. It's the global market in which currencies are bought and sold. This market runs 24 hours a day, 5 days a week. And it is the largest financial market by far. Almost $7 trillion are traded every single day on the Forex market. That's more than stocks, crypto, futures, and anything else. And what you're trading in Forex is called currency pairs. Basically, you're trading one currency against another. Simple. For example, Euro USD. That's Euro versus the dollar. If you think the Euro is gonna go up in value against the dollar, you buy. But if you think it's gonna go down, you sell. But just to be clear, you're not buying any physical money. You're not gonna be receiving any euros or dollars in the mail here. You are simply speculating on the price differences between two currencies. If price goes the way you expected, you win. If it doesn't, you lose. So the main idea in Forex, just like any other market, whether it be crypto or stocks, is buy low, sell high, or sell high and buy back lower. It is all about catching the right direction, managing your risk, and doing it in a way that's repeatable and disciplined. Now, not all currency pairs are treated the same. Let me break that down for you really quickly. There are major pairs, minor pairs, and exotic pairs. See, major pairs are the pairs that are most commonly traded throughout the world. Every single major pair involves the US dollar on one side, and that's because the dollar is the world's reserve currency. Examples include Euro USD, JBP USD, USD JPY, USD CAD, and so on and so forth. Minor pairs are also called cross-currency pairs. Minor pairs don't include the US dollar. Examples would be Euro JBP, Euro JPY, and Euro GBP. So now let's get into exotic pairs. Exotic pairs usually include a major currency on one side and the currency of a developing or an emerging country on the other side. An example would be USD TRY or Turkish Lira, or USD ZAR, the South African Rand. Now exotic pairs are not really recommended for beginners. That's because they have a lot of slippage and can move very, very fast. For now, I recommend you stick with the major pairs while you learn. They're cleaner, more stable, and easier to follow, especially while you build your first strategy. So just to recap, Forex is the foreign exchange market. You're always trading one pair against another. That's it. So before we go any deeper, let me just run you guys through the most basic terminology you will need before we continue the series. First one, currency pair. So as we discussed, a currency pair is just one currency paired up against another currency. That's it. Currency pairs have two parts. The first currency is called the base currency, and the second currency is called the coat currency. So if we take Euro USD as an example, Euro is the base currency, USD is the code currency. Next off, a pip. Pip stands for percentage in point, and it's typically the smallest movement a currency pair can make. So if Euro USD makes a move from 1.000 to 1.001, that's a move of 1 pip. Think of pips like points in the Forex world. It's how you measure movement, and it's how you calculate your profit and loss. Next up is the lot size. Lot sizes are just the size of your trade. That's all. Here's how it breaks down. One lot is 100,000 units of the base currency. This is called a standard lot. You can also have 0.1 lot, which is 10,000 units. This is usually called a mini lot, or you can even have 0.01 lots, which is only 1,000 units of the base currency, and is usually called a micro lot. Now, this is very important to remember. The bigger your lot size, the more money you make or lose per pip. So for example, if you're trading one lot, each pip might be worth $10. If the market moves 10 pips in your favor, that's $100. But if it moves against you, that's $100 loss. And that's why understanding your lot size is critical to managing your risk. Next up, we have leverage. And this is where things can kind of get pretty dangerous as a beginner. Now, what leverage essentially does is allow you to control a large position with a small amount of money. For example, if your broker gives you 1 to 100 leverage, that means for every $1, you control $100. So, with that same 1 to 100 leverage, if you had $100, you can make a trade for $10,000. Sounds pretty powerful, right? It is. However, it also amplifies your risk a lot. Leverage can and does increase your profit potential, but first it increases your loss potential, so keep that in mind. Now, let's tie leverage to margin. Margin is the amount of money your broker requires you to put down so you can open up a leverage trade. You can think of it kind of like a deposit. So if you're using 1 to 100 leverage and you're opening a $10,000 position, your broker may only ask you to keep $100 in that position. But if the trade goes against you and you lose that $100 that you put in, your broker has the right to close that position. That is called a margin call. Now let's talk about spread. And spread is important because that's how most brokers make their money. The spread is the difference at the bid price, what you sell at, and the ask price, what you buy at. For example, if Euro USD is at 1.1000 to sell, but it's at 1.1002 to buy, the spread is the difference between those two numbers. That would be a spread of 2 pips. So even before your trade moves, you're down 2 pips, meaning the markets have to move 2 pips in your favor for you to break even. Typically, you want to find a broker with lower spreads. We'll talk about that later and the broker that I use. Now let's get into the stop loss. One of the most important tools in trading is a stop loss. So a stop loss is a risk control feature that automatically closes your trade once the trade goes against you by a certain amount. Let's say you enter a trade and place a 20 pip stop loss. If the market drops 20 pips, your trade automatically closes. This protects your capital and your account from being completely wiped out. A take profit is the complete opposite of a stop loss. It's an automatic exit that closes your trades once you hit a set profit target level. So if your target is 50 pips and your trade hits it, boom, automatically closed. Always use stop losses and take profits. Lastly, we have the risk to reward ratio, or R/R. This is how much you're willing to risk compared to how much you're aiming to make. So let's say you risk $100, but your take profit is at $300. That's a R/R of 1 to 3. Now here's why that matters. Even if you only win 3 or 4 out of every 10 trades, you can still be profitable. No one wins 10 out of 10 trades every single time. R/R matters because when you win big. And when you lose small. Most professional traders, myself included, aim for R/Rs of 1 to 2 or 1 to 3. R/R is a huge part of having longevity in this game. So now you have the basic language of Forex. You're ready to go on to the next step. Now look, I know what you're thinking, this is confusing, and yes, it may seem like a lot at first, but you're gonna hear these words again and again and again. Trust me, you'll get used to it, and it's not as bad as it seems. If you ever get confused, come back, look at this video, watch the definitions again, but trust me, you'll know all definitions by heart. So candles and trends show you what's happening in the market, but supply and demand shows you why it's happening. In the next video, I'll be breaking that down for you super simply and showing you how you can build your own trading edge.